Imagine a world where you truly own your financial data, not your bank.
Hmm.
Now imagine you could easily share it to get better services, but uh, only if the banks themselves chose to let you.
Right. That's not hypothetical, is it?
Not at all. It's the fascinating reality of open finance in Switzerland.
Yeah.
Today we're taking a deep dive into this, well, transformative trend in the financial industry.
Yeah, it really is changing things.
We're talking about the controlled, secure exchange of your financial data across a really broad spectrum of products, mortgages, pensions, insurance, not just your basic checking account.
Exactly. It goes way beyond just payments.
And our mission today is to unpack a recent master's thesis. And it's complemented by interviews with banks, fintechs, all the key players right there in the Swiss open finance scene.
Real on-the-ground insights.
We want to understand how Swiss banks are navigating this, well, completely voluntary landscape, what's driving them, or maybe more interestingly, what's limiting their engagement.
Okay, let's start at the beginning then. What exactly is open finance? Can we break that down?
Sure. So at its core, it's about the secure exchange of financial data.
But not just payments, right? That's open banking.
Precisely. Open finance goes broader. Think mortgages, pensions, investments, insurance, your whole financial picture.
And how does this sharing actually happen? Securely, I hope.
Yes, definitely. It uses technology called APIs, application programming interfaces.
APIs, like secure digital pipes.
That's a great way to put it. Secure pipes letting different systems talk directly. And the really key thing here, it shifts data ownership.
To the consumer, to me.
Exactly. You get to decide if you want to share your information with, say, a third-party budgeting app or an investment platform.
Okay, that sounds powerful. What are the big picture benefits then?
Well, the potential is huge. More competition between providers, which should spark innovation.
Better services, hopefully.
Right. A transformed user experience. Think seamless financial planning, maybe finding the best loan without visiting 10 websites.
Yeah.
Ultimately, it empowers you with more choices.
But it can't all be smooth sailing. What are the headaches, the challenges?
Oh, definitely challenges. Big ones. Protecting your data, that's paramount.
Security, right?
Security, building and maintaining trust.
Mm.
And then there's the simple question of whether the big banks, the traditional institutions, are actually willing to, play ball, to open up.
And that willingness or lack thereof ties into how it's being rolled out globally, right? You mentioned the regulatory difference.
Exactly. This is where it gets really interesting. If you look at the UK, the EU,
They mandated it, didn't they?
largely, yes.
Yeah.
Regulation-led models. It's basically the law telling banks they have to provide access.
Okay.
But Switzerland took a completely different path.
The voluntary route.
Purely voluntary. No specific law forcing data sharing. So it creates this unique environment where incentives, not rules, are everything.
So regulation means everyone has to join in, which helps with access.
Right, good for accessibility, competition. But the Swiss market-driven way offers flexibility. Banks can choose how and when.
But the downside could be.
Fragmentation. Slower adoption, maybe, if the incentives aren't strong enough or clear enough for the banks.
And data protection. How does that fit in without specific open finance laws?
Well, you still have foundational data protection laws. Think GDPR in the EU, and Switzerland has its own strong data privacy laws. These ensure you, the consumer, always have control and must give consent. You hold the keys, essentially.
Okay, so if it's voluntary, what's actually making it happen? What are the drivers, the enablers?
Good question. Two main things are pushing it forward. First, client expectations.
Us.
You, especially younger generations, Gen Z, millennials.
Yeah.
They're becoming a huge economic force.
Right. I read millennials will have the most disposable income soon, and Gen Z invests early.
Exactly. And they grew up digital. They don't just want seamless digital banking, they kind of expect it, demand it even.
And they're okay sharing data for that.
Increasingly, yes. The research suggests over half are willing to share data if it means better, more personalized services. That's a big shift.
Okay, client demand is one. What's the second enabler?
Technology, specifically those APIs we talked about.
The secure pipes.
Yeah, they're the essential tech backbone, much more secure than older methods like screen scraping.
Screen scraping, that sounds dodgy.
It kind of was, like a bot copying your screen.
Yeah.
APIs are direct, secure connections. But the key within technology is standardization.
Meaning everyone uses the same type of pipe connection.
Pretty much. Avoids a situation where every bank speaks a different digital language, which would be a nightmare for integration.
Did other places mandate standards?
The UK did, yeah. To force interoperability, the EU is a bit more technology neutral, allowing different approaches. Switzerland is pushing for standards too, but through industry initiatives.
Got it. So clients wanting it, tech enabling it, who are the main players in this whole ecosystem?
Okay, let's map that out. 4 key actors. First, customers, that's you. Source of the data, demanding the services.
Makes sense.
Second, financial institutions, mostly banks. Traditionally, they held the data closely, but now they're adapting. Slowly, perhaps.
Number 3.
Third-party providers, or TPPs, often fintech startups. They're the ones using the data to build innovative apps and services. But they face hurdles, like those inconsistent APIs or bank reluctance.
Okay, and the 4th?
Data aggregators. Think of them as intermediaries. Crucial ones, actually.
Like who? You mentioned one earlier.
Right, like SXX's Blink platform here in Switzerland. They build the connections, simplify the integrations between banks and fintechs. Reduces costs.
Like a central hub.
Exactly. Though their power can also raise questions about, market concentration down the line.
Okay, so we have the players, the tech, the context. Let's get to the core of the Swiss situation. Why do banks participate, given it's voluntary? What's in it for them?
Right, the incentives. There are a few key ones. One big potential is actually monetizing data.
Charging for access.
Potentially, yes. PwC, for example, thinks this could be a major revenue stream. Banks getting paid for structured, secure data sharing with customer consent, of course.
Interesting. What else?
Standardization, as we discussed. Using platforms like Blink simplifies everything, lowers integration costs dramatically. The Swiss Bankers Association basically sees this as essential.
Makes it easier and cheaper to connect.
Yep. Then there's third-party verification. Things like licensing requirements for fintechs, using the data to reduce fraud risk, which makes banks feel safer.
And you mentioned reciprocity. Getting data back.
Yeah, the idea that if you share data, you might get access to data from others in return. It's a bit limited in Switzerland currently, mostly just within multi-banking where banks share account info amongst themselves for consolidated view.
Okay, those sound like pretty good reasons. So why isn't everyone jumping in? What are the blockers, the barriers holding them back?
The barriers are significant. A major one is legacy IT systems.
Old computers.
Basically, yeah. Fragmented, outdated systems. Remember that stat? 30% of U.S. banks said their systems just weren't ready for open finance.
Wow.
Leads to errors, slow processes, and upgrading or integrating?
Yeah.
That requires huge financial investment. And guess who usually pays?
The banks holding the data.
Typically, yes. It's a big cost.
Yeah, what else stops them?
Security and liability. This is huge, especially for cautious Swiss banks.
Data breaches, fraud.
Exactly. Cyber attacks. And if something does go wrong, who's legally responsible? Who takes a reputation hit? The liability framework isn't always crystal clear. That makes banks very hesitant.
Understandable. It's their neck on the line.
Totally. It's a nightmare scenario for them.
So given these challenges, how is Switzerland actually trying to make this voluntary approach work? What are the specific initiatives?
Well, the government, the Federal Council, is playing an interesting role. They want open finance, but they prefer the industry to lead voluntarily.
Watching from the sidelines, sort of.
Kind of. They monitor progress.
Yes.
In June 2024, they actually decided not to step in with mandates for now, saying the industry showed enough commitment, especially on multi-banking.
But they're keeping an eye on things.
Definitely. Watching multi-banking, third-party access, and maybe expanding into securities, pensions, it's like, okay, show us you can do this, or we might have to regulate later.
And that multi-banking initiative you mentioned, tell us more.
Right. Launched in May 2023. The idea is simple. Let you see all your accounts from different banks in one place.
Through my main bank's app or a third-party app?
Either. It's read-only access. Was planned for Q2 2025.
What?
Some delays. Concerns around anti-money laundering compliance popped up. It just shows how those risk factors are always present.
Okay, so multi-banking is one key effort. What about those platforms making it easier?
Yeah, Blink is central here, run by SXX. It's the main connectivity hub.
Connecting banks and fintechs with those standard APIs?
Exactly. It enables multi-banking, but also wealth management use cases, accounting links. What's really useful is it provides a single contract, checks on the fintechs, manages consent centrally.
Streamlines the whole process.
Massively.
Yeah.
Over 16 banks are on it already, which shows it's gaining traction.
Are there other standardization efforts besides Blink?
Yes, definitely. There's Swiss fintech innovations working on a common API, openbankingproject.ch with their Swiss NextGen API, and the Open Wealth Association focusing specifically on wealth management tech. Lots of moving parts trying to create common ground.
Okay, so we've got incentives, barriers, specific initiatives. But how does an individual Swiss bank actually decide? Do we connect to this fintech? Do we join this initiative?
This is where that research, the master's thesis, brings in a really useful concept, the decision funnel.
A funnel, like filtering things out?
Exactly. Think of it as a series of gates or filters. An opportunity has to pass through each stage to get approved. It starts broad with external factors and gets progressively narrower and more focused on internal hurdles. It's dynamic, not just a checklist.
Okay, I'm intrigued. Walk us through this funnel. What's the first stage?
Stage 1, external pressures. This is the widest part. Does the market, do clients need this?
So client demand is key.
Absolutely the most important driver, according to the interviews, especially in corporate banking SMEs, expecting their bank to link with accounting software like Bexio or Abacus.
Or wealth management clients wanting a full picture.
Right, they're actively pushing banks. If banks ignore this, they genuinely risk losing clients.
What other external pressures are there?
Peer and ecosystem pressure. Basically not wanting to fall behind. If competitors offer something, or if key partners like Abacus set a standard, banks feel pressure to keep up. Avoid that negative differentiation.
Being the odd one out.
Exactly. And finally, regulatory anticipation, that background hum we mentioned. Doing things voluntarily, like using Blink, is partly strategic to show progress and hopefully avoid stricter rules, like the EU's PSD2.
Okay, so if the pressure is there, what's stage 2?
Stage 2, strategic fit. Does this opportunity actually align with our bank's goals and make commercial sense?
Ah, the business case. Does it make money?
Precisely. A clear business case and potential for monetization is crucial. Unlike the EU, Swiss banks can often set their own prices for API access.
Really? What kind of prices?
We heard examples like 10 to 15 Rappen per API call, flat monthly fees, one-off onboarding charges. Some are free, but it's all negotiable.
So they need to see a return.
Yes, or at least clear strategic value.
Yeah.
They also look hard at client value and relevance. Is this genuinely useful for our clients? Does it solve a real problem or just add noise? It can't be just tech for tech's sake.
Okay, passes external pressure, fits the strategy. What's next? Stage 3 must be tricky.
You bet. Stage 3, risk assessment. This is where the inherent caution really comes into play.
What kind of risks are they scrutinizing?
Several big ones. Competitive threat and loss of customer interface. Banks hate the idea of becoming just a dumb pipe in the background.
While a flashy fintech app gets all the customer attention.
Exactly. Fintechs are often faster, better UI UX. Smaller banks feel especially vulnerable here.
What else?
Concerns about regulatory fairness. Are they opening up data to fintechs that don't have the same heavy compliance burden as the bank itself?
Seems fair.
And the big ones, security and liability. We touched on this. Fear of breaches, fraud, cyber attacks. And who pays if it goes wrong? It's a massive hurdle.
And compliance risks, like that AML issue in multi-banking.
Yes, regulatory and compliance risks, especially AML, are significant when you're sharing and receiving data. And finally, just the IT integration complexity. Is this going to be a nightmare project? They want scalable, efficient solutions.
Wow, that's a lot of potential no's. If an opportunity survives that, is there a final stage?
Yes, stage 4, mitigating conditions. If the risks identified in stage 3 are deemed manageable, the bank imposes conditions to control them.
Like what? How do they protect themselves?
They conduct strict use case evaluation, really digging into the fintech's model, how they'll use the data, their long-term plan.
Checking them out thoroughly.
They also strongly prefer strategic partnerships and embedding models, meaning they integrate the fintech service into their own platform, keeping control of the client relationship.
Smart. Keeps the customer interface.
Right. They use flexible pricing models to control the commercial terms. And, very importantly, they usually mandate using a preferred data sharing mechanism, which is often Blink.
Why Blink specifically?
Because it streamlines onboarding, offers network effects, reduces the hassle of managing lots of individual connections, and performs rigorous due diligence checks on the fintech's compliance and security. Although some point-to-point connections still exist, especially in wealth management.
In consent.
Absolutely non-negotiable. Explicit client consent is required for everything, often managed via Blink's central system. It clearly defines who's responsible.
Okay, that funnel, external pressure, strategic fit, risk assessment, mitigation makes a lot of sense for a cautious voluntary market. How does it explain what we actually see happening? Why is progress faster in some areas than others?
It explains it perfectly. Let's apply it. Take corporate banking.
Okay.
Strong, clear client demand. Remember the accounting software integration. Check. Clear strategic fit, often monetizable. Check. Risks manageable, especially via blink-in pricing. Check.
So it flows right through the funnel.
Pretty much. That's why we see good progress there.
What about wealth management?
Also, strong client demand and strategic importance. Good activity. But interestingly, it often uses older point-to-point connections, not always the standard APIs.
Why is that? Doesn't pass the risk or IT stage easily.
Kind of. Banks there often prefer solutions that minimize their integration effort and cost, even if it's less standardized. They prioritize control and reducing their immediate project risk.
Got it. And the laggard, retail use cases.
Yeah, retail struggles with the funnel, external pressure, often weak, fragmented client demand. Monetization, unclear banks doubt retail customers will pay.
High risks too.
Very high perceived risks. Competitive threat from fintechs, compliance hurdles like AML, operational complexity. So many retail ideas stall early in the funnel. Multi-banking is the main effort, but it's slow precisely because of these factors.
The funnel is a really powerful lens. So wrapping up, what does this all mean? What are the practical implications of this Swiss decision funnel for everyone involved? For you, listening.
Great question. Let's break it down. For banks, the funnel is incredibly useful. It gives them a structured way to evaluate opportunities.
Improves internal alignment.
Definitely. It gets strategy, risk, IT, business folks talking the same language. It can actually lower barriers for banks that are hesitant by providing a controlled way forward, and it makes expectations clear for partners. Plus, its good governance shows they're being responsible with data.
Okay, what about for the fintechs trying to partner with these banks? Is the funnel just a wall?
Not necessarily. It's also a guide. It tells them, banks are open, but you need to come prepared.
How so?
Your solution needs clear client value. It needs to align with the bank's known strategic priorities. And you must have solid answers on security and regulation. Understanding the funnel makes the bank's thinking transparent, reduces guesswork for the fintech.
So do your homework on the bank's needs and risks.
Exactly. A well-prepared pitch that addresses the funnel stages has a much better chance.
And finally, for regulators, what's the value of understanding this funnel?
It's like a diagnostic tool for them. They can see where market-led efforts are getting stuck. Is it lack of demand, unclear business cases, unmanaged risks?
Allowing for more targeted interventions if needed?
Precisely. Instead of just imposing broad rules, they could potentially design more nuanced measures to address specific blockages identified by the funnel. If the voluntary approach isn't delivering enough progress.
So, to sum up our deep dive today, open finance in Switzerland is happening, but it's selective. It's carefully guided by this intricate decision funnel.
Yeah, it's a real testament to how market forces are interacting with strategic caution, with risk management, shaping this unique financial landscape.
It really is a fascinating case study.
It absolutely is. And maybe here's a final thought for you to mull over.
Go on.
As we dug into the research, we heard some surprising perspectives. Despite all the mandatory regulation in places like the UK and EU,
Right, despite that big regulatory push.
some people we spoke to, involved in the Swiss system, expressed real doubts about how effective those mandates have actually been elsewhere. We heard comments like, in the UK, it was mostly a failure, or that in the EU, implementation was too complicated and lacked real standardization in practice.
And what's even more striking, some argued that Switzerland, with its voluntary market-driven approach focused on specific use cases through platforms like Glink, might actually be further ahead in standardizing certain key areas than the regulated markets.
Which raises this really provocative question for you. Does forcing the issue with strict regulation always guarantee the best outcomes in something complex like open finance?
Or could it be that a market-driven approach, one that's carefully guided by rigorous risk management from the banks themselves, and crucially, clear commercial incentives, might actually foster innovation that's more sustainable, more aligned with real needs in the long run?
What does Switzerland's very distinct path tell us about the best way to manage this global shift in finance? It's definitely something worth pondering as this whole landscape keeps evolving so rapidly.
A lot to think about, for sure, as finance continues to change.
And that wraps up our deep dive for today. Thank you so much for joining us. We hope you feel a little more clued in, maybe a bit more intrigued about the very nuanced world of open finance, especially how it's playing out in Switzerland. Until next time.